Sellers fear Trump, buyers fear Warsh. After this latest Fed meeting, the market is completely lost. Some see hawks, others see doves. There's absolutely no market consensus. But that's exactly the smoke and mirrors Wash wanted to create. Under Powell, traders were spoon-fed by Fed speeches and dot plots. But from here on out, the era of forward guidance is officially dead. Warsh just played masterclass defense, blurring the market expectations. While the rest of the Fed was screaming hawkish, Wash abstained, even covering for Trump by claiming war-driven inflation isn't a real threat. When grilled by reporters, he basically pulled a "don't ask me, I know nothing" routine. He knows exactly what he's doing. It's more like
Stop asking or I'm going to blow my cover.
what a brilliant Trump-style dove disguise in hawkish feathers. Wash knows that only by muddy the waters can he secure maximum policy flexibility down the road. With expectations completely blurred, US stock futures actually reap higher after hours, creating this bizarre illusion that the Fed was discussing rate cuts. Right now, ultra short-term equities don't care about fundamentals. It's a pure liquidity inflow. Tonight is Thursday, and with US markets closed on Friday, tonight during Asian hours is the critical sentiment window for a triple reaching. This is a highly orchestrated institutional setup that cannot fail. Brace yourself for extreme volatility tonight. If the Fed cannot no longer serve as a market anchor, we are likely heading into a choppy and sector rotating consolidation phase. So, zooming out, what actually drives US stock from here? The real test will be the Max 7 Q2 earnings in late July, followed by the Q3 reporter season. We need to watch how rate hike fears impact big tech's capex, and more importantly, whether their financial model is shifting from cash driven to debt driven. Which, as I mentioned yesterday, Nvidia is already leading the chart on. If that financing made up 65% last year, will really spike by the end of this year? CapEx is the absolute bedrock of this AI mania. If it cracks under high interest rates and that pressure, the entire stock market will pilk. Unless AI monetization keeps growing at a breakneck pace, higher for longer rates will eventually pop this bubble. Now let's talk gold. Since early June, the trading narrative has been critical clear, testing the cost of capital on one hand and hedging geopolitics on the other. Last night's US-Iran agreement did provide a short-term floor for a gold bounce, but notice the price action. That weird deep then reap behavior proves the market simply doesn't buy that the Fed has the guts to hike rates. However, just because they don't hike doesn't mean the Fed won't use hawkish jawboning to drain liquidity. The Fed's hawkish baseline remains intact. They can weaponize rate hike expectations at any moment and driving up the cost of capital and leaving the entire tape incredibly fragile. So make no mistake, this move in gold is just a bounce, not a structural trend reversal. For gold to launch into a true secular bull market, we need one of two hand conditions: a breakdown in fiat currency credibility or a total loss of fiscal discipline. Right now, the former is suppressed by a reaping US dollar, while the latter is kept in check by high capital costs. While central banks are beating the floor at any cost, giving gold massive resilience, remember they are buying strategic reverse, not trading the swings to pump your bags. For gold to truly go parabolic, we must wait for liquidity to loosen up or for the market to start pricing in a massive US fiscal deficit again. Long-term bullish, but expect short-term pain. Finally, on crude oil. Looking at the tape around 75, I'm honestly running out of direction. I think we got a short-term bounce, but I know many traders, myself included, have lost the stomach to buy this dip. For oil to make a real round back up, it needs a definitive catalyst. The key now is to keep your eyes glued to the US-Iran talks in Switzerland. You might think geopolitical will fleet float again next week, like Israel stirring up trouble, but what if this time the market is that set on using the peace talk as an excuse to completely flush out the loans? At the end of the day, in this extreme market, going long comes down to one simple question. Even if you were 100% sure oil hits 150 by year end, do your position sizing and leverage allow you to survive the drawdowns up to see it? If you can take the heat, take the trade. If not, step aside. Don't force it. Wait for the macro fog to clear before making a move. In a market with no clear direction, sitting on your hands, trading less, and watching key levels is the only playbook that matters. As always, this is just my personal trade analysis, not financial advice. And also, shout out to EBC Financial Group for sponsoring the content. Bye bye.